And where are you going? What do you want?
Hello and welcome to People Making Money. My name is Kevin Bemel, and we're here every Wednesday at 10 a.m. Pacific time to talk about running a business, job hunting and building a career, building wealth, all of the topics related to finances in our lives, both personal and business. So today is our monthly Economic Echoes show, where we take a look at the economic data for the previous time period and do our best to figure out how does this affect us as individuals, and what decisions do we need to make for our families, for ourselves, for our businesses, etc. So it's all good and well to hear that the CPI is X and unemployment is Z, but you know, as I've mentioned many times in this particular set of shows, um, when we're employed, our employment rate is 100%, and when we're unemployed, our unemployment rate is 100%. So it doesn't matter for us as individuals per se that the unemployment rate is, whatever it currently is. We'll take a look at that in a few minutes. So usually the first thing I take a look at is the consumer price index. I wanted, though, to share with you an article that I read recently in the Wall Street Journal that I thought was quite interesting, and it talks about an issue that I've mentioned on this show from time to time, and that is that when we look at a particular economic indicator, typically we can't really understand what it's telling us in isolation. So we need to look at two or more indicators at a time to really understand what it's saying. So, and this was an opinion piece in the Wall Street Journal. It was about a week ago or so, and it's written by George Gilder and Gail Pooley, and let's see, George Gilder, he wrote a book called Life After Capitalism, and Mr. Pooley is a professor of economic history at Utah Tech University, and they both are fellows at the Discovery Institute in Seattle. So I don't know them personally, but they sound like credible individuals. So the point there that they make in this op-ed is that the consumer price index all by itself tells us nothing about changes in affordability. So they are advocating that prices should be measured with respect to time. And what they mean is like hours worked in order to be able as hours worked as the basis for the cost of something. So let me see if I can scroll down here. Okay, so one of the points they make is, unlike money, time can't be counterfeited or inflated. I think that's a brilliant observation. Frankly, we all get 24 hours a day that we choose to use however we choose to use it. It's not like if something happens, we get 25 hours a day or something like that. Okay, so what they're proposing is that the cost of, let's say, a loaf of bread be described in how much time somebody has to work at the median income in order to be able to buy that loaf of bread. And that's a particularly apt idea because, and I'm just going to stop the sharing here for a minute. That's a particularly apt idea because the reality is, 200 years ago, somebody might have had to have worked for, an entire day to afford to buy a loaf of bread. maybe whatever it was, right? Today, a loaf of bread costs roughly, half an hour, based on the uh, uh, based on the minimum wage rate, the federal minimum wage rate, and it costs maybe 6 minutes based on the median hourly wage that we'll look at in a few minutes, right? And so, if let's just say in past times, somebody had to work, if somebody worked, they got 5 cents an hour, and a loaf of bread cost 5 cents. They had to work an hour to get a loaf of bread, whereas today, they have to work 6 minutes. So the cost of bread has actually dropped, right? By what took 60 minutes to now 6, it's dropped by a factor of 90%, right? It's become 90% more affordable. Now, we can argue about the utility of the bread. It was the bread 200 years ago as healthy as the bread today. It's obviously there are varying factors there, but I'm using a simplified example to help you understand how merely looking at one economic indicator doesn't convey much of anything about what's really happening in the economy. Okay, so with that said, let's take a look at the consumer price index for last month. Open this up for you. Okay, there we go. And where is it? Here is okay. So the CPI for all items in March fell 0.1%, right? So we actually had deflation, slight deflation, and for the full 12 months rose 2.4%. So still higher than the Federal Reserve's target of 2%, but not a whole lot higher. Okay, the index for all items except food and energy increased 0.1% in March and was up 2.8% over the previous 12 months. So that's significantly higher than the Federal Reserve's target. Okay, so all items, you can see this. That's essentially what we're looking at here. So let's look at food. So food went up 3%. Food at home went up 2.4%. Food away went up 3.8%. Okay, so what went up? Once again, we see that proteins, meat, poultry, fish, and eggs went up almost 8%. Okay, dairy products went up 2.2%. It doesn't want to let me see this. Alcoholic beverages and other beverages, non-alcoholic beverages went up 2.4%. Okay, cereal and bakery goods about 1%. Fruits and vegetables went down almost 1%, 0.7%. That's good news for me because that's I eat a lot of those. And then other foods at home went up 1%. Okay, so returning to the top level, now let's look at food away from home. So full service restaurant went up 4.1%. Limited service meals and snacks went up 3.4%. So no matter what you do, if you're eating out, you're paying more. Now, energy overall went down 3.3%. So you see food went up 3%, but energy went down 3.3%. So overall the cost of energy offset the increase in food. However, if you're not a big energy consumer, that doesn't help you out. Okay, so energy commodities went down 9.5%, whereas energy services went up 4.2%. So let's look at commodities, right? Okay, fuel oil went down 7.6%. So if you live on the East Coast where you use fuel oil for heating, good news for you. If you live here on the West Coast, has little, if any, impact on us because generally speaking, we use electricity and natural gas, not fuel oil, to heat our homes. Okay, gasoline went down almost 10%. Right now, if you don't drive or you drive very little, like me, didn't really help you out. But if you drive a lot, if you commute a long distance, right? So you saw your gasoline bill presumably went down quite a bit. Okay, so that's now let's look at energy services. Okay, so electricity went up 2.8%, but look at this, natural gas went up 9.4%, right? So here I live in California. The cost for me to heat my home and run my cooktop went up over 9%, right? So for me, although energy prices went down 3.3%, because I don't drive very much and don't use fuel oil, and because I do use natural gas, it's more likely that the cost of energy for me went up. And that's why I go through this so you can see for yourself what happened vis-a-vis energy costs. Did you really get the benefit of this overall drop in energy costs? Okay, and then categories that don't include food and energy. So commodities went down 0.1%. So basically unchanged. Services, less energy, went up 3.7%. Let's drill down. Okay, there we go. Okay, so apparel went up 0.3%. New vehicles didn't change. Used cars went up 0.6%. Medical care commodities went up 1%. Alcoholic beverages went up almost 2%. And tobacco products went up 6.8%. I was talking to a friend of mine yesterday. He and his wife had been to Las Vegas not too long ago. He was telling me a pack of cigarettes costs $15. And at a gas station here in Los Angeles, he noticed just not too long ago that a gas station was offering, if you bought 2 packs of cigarettes, you could buy each one for $9.84, or almost $10 a pack. I had no idea that the cost of cigarettes had gone up that much. Back when I was in college, I don't think a pack of cigarettes they cost $1, something like that. So you can see tobacco products have gone way up. Now, if you don't smoke, who cares? If you don't drink, who cares? So if you don't smoke or drink, you saw probably very little change in the cost of commodities, food, and energy. Okay, now let's look at the other side of this, which is services less energy. Okay, so housing went up 4%, medical care 3%, and transportation services a little over 3%. So most of us use all these services. Okay, so it's hard to escape, and this is why they call this the core rate, because most of us do not escape the impact of this particular one. Okay, so we all use these services, and though now we may or may not use any of these commodities, we may not have bought any new clothes or bought a car or used any medical commodities, but you know but they are things that pretty much no matter, with the exception of something like alcohol and tobacco, with the exception of those two, everybody has to wear clothes. Everybody's going to need some kind of medical care commodities at some point. And again, cars may or may not need those. Okay, so that's the inflation side of things. Now, the balance the inflation side then with looking at what's going on. There we go. What's going on from an income standpoint. Okay. So I mentioned a few minutes ago let's see. Okay. So here we go. Average. So this is, first of all, real average hourly earnings. And it is, I talked about this on this show last week, that it's unfortunate they use an average, because I just want to double check something. Yeah, okay, yeah. I don't know if I assume they're using the mean when they say average, as opposed to the median. The median would be much more accurate. But in any event, this is what the Bureau of Labor Statistics um, uh, puts out. So average hourly earnings $11.26, up 3 cents from last month, and up 15 cents from a year ago. Okay, average weekly earnings went up. Let's see, $1.15. Okay, uh, this is this is weird. Average hourly earnings. Wait a minute. Oh, okay, yeah. So these are inflation adjusted. So our actual, yeah, that our actual hourly earnings had. So I was looking at something there. Our actual hourly earnings, $36 an hour. Average hourly earnings, $36 an hour, up from 35.91. Okay, average hours worked was constant. So average weekly earnings was $1,231.20. So up a little over $2. Okay, so you can see that in general, um, month over month, income increased 0.3%. Now, if you recall, inflation month over month was 0.1%. So it would seem that we gained some ground going from February to March, because earnings increased more than inflation did. Okay, but of course, that all depends. Again, if you recall, if you're not an energy user, okay, or I should say, if you don't drive very much or don't drive at all and don't use heating oil, your cost of energy went up. And so if you're not feeling like you gained any ground, and whatever ground you gained was very small, that's not an illusion. It's very possible that you lost ground, because unless you didn't buy gasoline, you probably experienced inflation March to February that was higher than the national average. Okay, and so that's why you're feeling like, wow, inflation didn't seem so low to me, right? Because if like me, you have a drink, once in a while or whatever, and you don't buy gasoline and heating oil, so you definitely experienced higher inflation than the national average. Okay, um, year over year, so real average hourly earnings went up 1.4%. Okay, real weekly earnings though went up only 0.8%. And the real average weekly earnings are more important, because you can see here, average hours worked went down 0.6%. So although wages went up, people worked less on average. Now, again, these are the averages, so that doesn't say that's what happened to you. But again, we can't look at any of these statistics individually. We need to look at them collectively. So maybe you got a raise, but also your hours were cut back, and you may not be making more money than you did, a year ago or a month ago. And so you're not working as much. Maybe you have more free time, but that won't help if your budget is pinched, right? So these are the things to consider as you look at your overall economic situation. Okay, next, let's look at the unemployment rate. Now, again, as I've mentioned, whenever I look at the unemployment rate cannot be under. What did I do here? Okay, the unemployment rate cannot be understood on its own. It has to be looked at with the workforce participation rate. Okay, so going from February to March, the unemployment rate went up 0.1%. Can't exactly say why. For men, okay, it was unchanged February to March, and for women, okay, February to March, it went down 0.1%. Okay, so essentially unchanged. Let's look, and then for teenagers, January, February. Okay, so it went up 0.8%. from 12.9 to 7. So teenage unemployment definitely increased going from February to March. Okay, now looking by demographic. So unemployment for white Americans went down slightly, a 10%. Okay, not a big change. For Black Americans, it went up by 0.2%. Okay, so a little bit bigger change. For Asian Americans, these things overlap, so I have to blank them out. Okay, so for Asian Americans, unemployment went up 0.3%. Keeps getting worse and worse for each group. And then for Hispanics or Latinos, it went down 0.1%. So for whites and Hispanics or Latinos, it went down 0.1%. For Black Americans and Asian Americans, it went up 0.2 and 0.3% respectively. Not super big changes. Okay. Now let's then look at that in comparison with the workforce participation rate or civilian labor participation rate. Okay. All right. So overall, the labor participation rate went from, let's see, here's February. February was 62.4. It went up to 62.5. So it went up 0.1%. Okay. For men, it went March 70%. February. Okay. So for men, it went up 0.2%. And for women, it went down 0.2%. Okay. And for teenagers, oops, what did I do here? There we go. Okay. So for teenagers, workforce participation rate, it actually went up. Oops, wait, January, February. There we go. 37.2 to 37. Okay. So it went up 0.4%. So at least a small contributor to the big increase in unemployment for 16 to 19-year-olds is more of them entered into the workforce, okay, but they weren't able to find jobs. Okay, so that's why they're that's part of the reason why their unemployment rate went up. Okay, now for white Americans, their workforce participation rate stayed the same. So there was a small increase in employment among white Americans. For Black Americans, oops. Okay, let's take this out. And I'm going to take this out too. Okay, here we go. Okay, so for Black Americans, workforce participation rate dropped from 62.7% in February to 62.2% in March, meaning it dropped 0.5%. And on top of that, unemployment went up by 2%. Okay. So despite fewer Black Americans looking for work, their unemployment rate still went up. Okay. That's not a good sign for employment of Black Americans. Okay. If more Black Americans had entered the workforce, that could have explained why the unemployment rate went up, but it was the opposite. Okay. Now let's compare that to Asian Americans. So Asian Americans, their workforce participation rate increased by 0.3%, as did their unemployment rate. So for Asian Americans, the explanation for their unemployment rate increasing could be more Asian Americans entered the workplace but didn't find jobs, and so that increased their unemployment rate. And then for Hispanic Americans, so their 66.9. Okay, so their workforce participation rate also went up by 0.3%. And despite that, their unemployment rate went down slightly, 0.1%. So that means a lot of Hispanic or Latino Americans found jobs because more people enter the workforce and yet their unemployment rate still went down. That's why it's important to look at these two statistics together. Okay, now let's look next at, here you go, employment by industry. Okay, so for the 1 month period, The biggest gainers in employment were uh, private education and health services, okay, which is largely driven by government spending, as I've mentioned many times before. Leisure and hospitality went up by 43,000 jobs. That's a great sign, okay. Government went up by 19,000 jobs. I suspect that's local and state governments increasing employment, okay. Construction went up 13,000 jobs. Retail trade went up almost 24,000 jobs. Transportation went up almost 23,000 jobs. So you see a lot, several sectors went up by 20, almost 20,000 jobs or more, and construction went up over 10,000 jobs. Okay, even financial activities went up 9,000 jobs, almost 10,000. Okay, the only ones that lost were information went down 2,000, and wholesale trade also went down 2,000. Other than that, every other sector was saw net increases for the one over the last month. So private educational services, you can see, actually lost jobs. So it was healthcare and social services, which again are both driven by government spending, that saw big job gains. Okay, and it was mostly in individual and family services. Okay, and then in healthcare, so all sectors of healthcare saw increased employment. Okay, so then jumping to the next largest gainer, which is leisure and hospitality, both categories, arts, entertainment, and recreation, and accommodations and food, saw big gains. Okay, and in reality, it was mostly food and drinking places saw 30,000 jobs, accommodations very few. Okay, and then in terms of art, entertainment, and recreation. So again, museums and historical sites lost jobs. That's been the trend. Whereas performing arts and spectator sports and such saw big gains, as did amusement and gambling and recreation. Okay, now let's look at, make that go away. Okay, let's look at government real quickly. So yeah, you can see federal government employment dropped. That would be expected with Doge and all of that. State government saw 6,000 increase. Local governments 17,000. Okay, local governments education saw almost 9,000, and the other parts of local government saw a little over 8,000. Okay, and state governments, okay, education went up 5, all the rest went up 1.3. And let's look at the federal. Okay, so federal government, except the post office, saw a loss of over 3,000 jobs, and then the post office lost about 700 jobs. Okay, I would expect those trends to continue with respect to government. Let's look next at retail trade. And you can see food and beverage retailers saw almost 21,000 new jobs. Motor vehicle and parts dealers, almost 4,000. Building materials, over 4,000. Music and sporting goods, hobbies and stuff, 1,000. Healthcare retailers, 2,500. General retailers lost almost 5,000 jobs. Those would be like Walmart and department, well, probably not necessarily Walmart, but department stores, that sort of thing. Okay. Furniture, home appliances, home furnishings lost almost 2,000, and gasoline and fuel dealers went down over 1,000. Okay, so you can see as gasoline prices dropped, stations laid people off. It appears. Okay, and bigger ticket items like furnishings went down, but other things, other sectors went up. Okay, now let's look at transportation and warehousing. So warehousing went down over 9,000 jobs. The big gainers were couriers and messengers. That's interesting. That must be, I don't know if that's, I assume that's like FedEx and that sort of thing. Went up almost 16,000 jobs. Truck transportation, almost 10,000. Support activities, almost 4. And then the rest were pretty much unchanged. Air transportation went up almost 1,000, whereas rail transportation dropped by about 700. So you can see those there. Okay, and then finally we'll look at construction. So construction of buildings, 2,700. Heavy and civil construction, 3,400. Specialty trades, over 6,000. Okay, and it was that was in the non-residential, because residential specialty trade lost 12,900 jobs, whereas specialty trades in non-residential saw a gain of 19.3 thousand. So you can see where construction activity is concentrated. Okay, and then looking at the other parts, construction of buildings. So that's interesting. So in construction of buildings, you saw an increase of 3,000 in residential and a drop of 400 in commercial. So if you're in the specialty trades, you're working on a lot of non-residential projects. But if you're in kind of construction in general, you're seeing more residential projects. Okay, so okay, and then now let's look real quickly at the losers. Wholesale trade. So this could well, no, this wouldn't be due to the to tariffs yet, because this is for March. So you're seeing jobs in wholesale, merchant wholesale durable goods went up 3,700. Non-durable goods dropped by 2,700. Trade agents and brokers dropped by 3,000. Now that isn't surprising, because there is a lot of disintermediation going on. Disintermediation means that middlemen are being taken out of the process. Okay, that's one of the things, for example, that the internet does, and so on the wholesale level anyway. And so you wouldn't be surprising to see those drop in jobs. Okay, and then let's see. Wholesale. Here we go. Oh, okay. That there's no detail there. And then let's look at information jobs. Okay, so motion picture and sound recording industries lost jobs over 1,000, but publishing gain 1,500. Broadcasting and content providers lost almost 1,000. Telecommunications lost almost 3,000, whereas computing and web hosting and such gained almost 2,000. So it's a kind of a mixed bag in terms of information, but overall information jobs dropped a little bit. Now, contrast that with the 12-month picture, okay? And you can see, for example, wholesale and retail trade are not nearly as prominent gainers over the last year as they were over the last month. Okay, the biggest gainer is private education and health services. Okay, followed by government. Now this is, that these two have for the last year have driven things. I expect to see some of this change going forward, because the Trump administration in general is not going to be hiring federal workers. Quite the opposite. Okay, leisure and hospitality also tends to be a gainer, and transportation and warehousing. Now that may, as we see the impact of tariffs, we may see transportation and warehousing start to drop. We may see drops in wholesale trade and retail trade. Okay, that we'll have to track that. Okay, so this is the 1 year versus the 1 month picture. Okay, next, let's look at median home prices. Okay, so for the first quarter of 2025, median home price nationally is 416,900. That's down from 419,300. So lost a little over $2,000. Probably due to the, and here, let's look at this. Look at the scale. Okay, here we go. We can see this better now. This is probably due to increasing interest rates, and so people are not buying homes. Now you can see, by the way, and let's look at the 5-year picture. So you can see that the median home price coming out of COVID skyrocketed from 317,000 to 437, almost 438,000. Okay, then it did top 440,000 for a short time, and it's since dropped down a bit, but it stayed right around the $420,000 mark, really since toward the middle of 2023. Okay, and except for this bump, it's really been in that lane since 2021. So this appears to be a permanent increase in median home price of essentially $100,000. Okay, so we're probably not going to see that ameliorate. We're likely to see median home price bumping along between, around the $420,000 mark until it takes its next big increase. And I realized I didn't put up the link for. Here we go. Yeah. Okay. So let me switch to the other median home price screen that I take a look at. Okay. So the median home price in California, for example, increased 6% year over year to 832,500. Okay. That's obviously, double the national average. Okay. Now, in terms of supply, okay, so the supply has been, bumping around between 80 and 100,000 homes, or around 80,000 homes for a couple of years now. Okay. Demand. Okay. So you can see, based on the number of prices that sold above listing price, okay, it's been around 40%, sometimes 50%. Now, this is an aberration. Okay, homes sold with price drops has been around 20%. Okay, so sales to list price, you can see it's been right around 100%. There hasn't been much variance when all is said and done on average. Okay, so let's look at a different market. Let's look at Miami, Florida. Okay, so here's Miami, Florida. Median sales price $632,000, about 1.5 times the national average. Okay, and it's been around that now for a couple of years as well, right around the 600,000 mark. Although it's been on a slow but steady increase, it appears. Okay, so demand. Okay, so almost 95% of properties sold um, uh, at the list price. Okay, only 4.5% sold above the list price. 18.5% sold below the list price. Okay, so in general, prices are selling at list price, or a little below in Miami. Okay, and okay, let's look at migration. Where are people coming from the most to Miami? Well, they're coming from, looks like Seattle, San Francisco, Los Angeles, San Diego, and a number of East Coast cities as well, right? You can see where people are coming from. The most are coming from San Francisco and New York, which shouldn't be too surprising because a lot of New Yorkers vacation in Miami. Okay. Oh, and here you can see by people. Here, New York, 5,800, San Francisco, almost 2,200, Washington, D.C., 2,000, and then so on down. Okay. Where are people going outbound from Miami? Well, a lot of them are staying at, let's see, all but 3 of the destinations, they're still staying in Florida. And another one is Atlanta. So they're staying in the Southeast, in Texas. The only place they're going to outside of the Southeast from Miami is Minneapolis. Okay. So now let's look at other market. Let's look at Omaha. Omaha. Oh, oops. No, so that's not giving me the right chart. I was concerned about that. Let's see. Don't do that. It doesn't want to do it. Yeah, this one gets kind of fickle sometimes. So, all right, we won't be able to look at another market, but I wanted to look at a market probably below the median national median home price, but it looks like Redfin is not going to cooperate with us. Let me just try one other thing. Nope. Yeah, it's not gonna cooperate. Oh well. Okay, it is what it is. Okay, so let's now switch to median rent. Here we go. Okay, so let's look first at Los Angeles. Okay, so month over month, rents dropped by $411 average rent. Wow. Okay. Now, the problem with an average rent is it can be highly affected by the high end or the low end of market, right? Where median is telling you the midpoint. But data for median rents just don't have it. So you can see that it in January of 2025, average rent was about 2,800, and as of April, it's wait, well, that's weird. Yeah. Okay. Oh, yeah. Okay. I'm sorry. Yeah. It's more like 27. Yeah, $2,733. There you go. So that's it's a sizable drop. Okay. Now let's see. Where's the okay? So now let's compare that to Miami. Miami monthly rent went on average went down 100. Okay, but it's interesting. The charts the charts are different. So oh, this I see. This is giving you the comparison year over year. So yeah, so from March of 2025 to March to April, it actually went up $50. So I'm not sure why it's saying $100 here, but in any event, you can see rents have been trending up in Miami since February. Okay, which was similar for last year, although they leveled off in March and then started to decline. Okay, and so it'll be interesting to see if how the trend plays out over time in Miami. Okay, now let's look at another area. Let's look at Omaha, Nebraska. Okay, Omaha, Nebraska also saw a slight decrease according to this chart, but here it's showing from March to April, it actually increased about $36. So, can't explain to you why they're showing different, but overall, although this chart is saying average rents are declining, the charts tracking over time show them increasing. And in fact, if we remember, the CPI shows that rents are increasing as well. So, what's happening in your particular city? And is it a good time to be looking for a place to rent? So that's something for you to take a look at. Okay, and then the last thing that I want to cover is consumer sentiment. Here we go. Okay. So the survey of consumers done by the University of Michigan is important because it gives an idea of where people's heads are at. So this will reflect what's been in the news about tariffs and such. So you can see across the board, consumer sentiment month over month has declined, around 11%. So index of consumer sentiment, how comfortable consumers feel, dropped by 10.9%. Current economic conditions over 11%. Expectations only slightly rosier than the outlook for the current economy. Okay, now even more dramatic is there's been a 34% drop year over year in consumer sentiment, and current economic conditions have seen a drop of 28.5%. And consumer expectations have dropped by 38%. Now, a lot of this is due to the discussions about tariffs and what impact they're going to have on the economy. So, let's see if they have a chart with this. Okay. Okay, so yeah, there's not a whole lot. I'm looking at the differences by by party affiliation. So, not a big difference in terms of inflation expectations, um, consumer expectations. You can see, how you can flip, right? In terms of how positive people affiliated with the party would, that presumably was going to win would be. You can see that over time. So, there's nothing here unexpected that, if I win, I'm optimistic. If my party wins, I'm optimistic. If my party wins, I'm optimistic, right? So no big nothing earth shattering here. So one of the things we have to take into account, I think, is, let me go ahead and stop the screen sharing, is that we don't really know what's happening with respect to the tariffs, in the sense that they've only been in place for about 10 days, or, well, no, I guess about 2 weeks. And how they're actually affecting the economy, we're at the very, very beginning of seeing. So there's a lot of consternation in the reporting of tariffs, and I don't see that differing very much by the political leanings of a particular media outlet. Uh, but the reality is, nobody really knows what people are actually going to do and how this situation is actually going to play out. And I think that the most important thing to take from this is, both bond prices are uh, um, going uh, down, okay, as are stock prices. Okay, so when there's economic uncertainty, typically what we see happening is people pull out of stocks and move into bonds, because bonds generally are a safer investment. Okay, but that's not what we're seeing. We're seeing people pulling out of both stocks and bonds, which means what they're doing is they're just pulling out of investments to see what will happen. So that uncertainty, which I think is essentially what's reflected in the indexes of consumer sentiment, is basically causing a lot of people to take a wait and see attitude. I've spoken to a number of people, both uh, in my practice as a fiduciary, but also talking to people involved. Like my guest yesterday, uh, um, Jason Hollander. He's an investment banker handling mergers and acquisitions of um, um, lower mid market to mid market companies with $1 million to $100 million in revenue. He and I had a conversation, and a lot of people, and he said, I think a lot of people are just taking a wait and see attitude. I'm not really sure how this is going to play out. So I would be careful about sort of buying into any particular view of what's actually going on, because we don't really know yet. I would be careful about making any major moves uh, based on current economic conditions, because we don't really know how this is going to play out. Okay, and until we get greater clarity, it's probably better to take some time, let the dust settle, and then will be in a position to make better decisions. Okay, so that's the economic echoes for this month, and I'm always interested to hear how this show works for you, whether it's giving you the kind of information that you want and need to hear so that you can make sound economic decisions. So please feel free to drop a comment in social media. All the links will be in the show notes after this episode posts. And if you want to share something private with me, feel free. You can, my email address is in the show notes as well. Always give the caveat, if you're asking me for advice or something, only if it's within my area of knowledge. I don't give legal advice. I'm not a lawyer. I don't give accounting advice. I'm not an accountant. I'm a businessman, a professional fiduciary, and I also do business consulting in a number of areas. And so if it's something related to that, I will be happy to converse with you about it, but not if it's outside my area of expertise. So I thank you very much for joining me at this month's Economic Echoes, especially those of you who are live. It's always a treat to see you. Tomorrow, Thursday at 5 p.m. Pacific time is my show Jiggers' Place, and it's my every other week show. We're going to sit back, have a cocktail, and talk about 19th century literature. Now, before you tune out, this is not going to be the way it was in high school. I'm going to show you why 19th century literature, Jane Austen, Thomas Hardy, George Eliot, who, by the way, is not a man. George Eliot is a woman. It's her pen name. Why it's so enjoyable and is so valuable to read these works. But it is better over a cocktail, at least when you're getting used to it. I mean, I can read 19th century literature without a cocktail these days, but when you're first getting into it, a cocktail will definitely help because it'll loosen you up and open up your minds. So look forward to that tomorrow at 5 p.m. If you would like to get the cocktail recipe in advance so that you can make it with me while I put it together at the beginning of the show, please subscribe to my email list. Just go to bemel.com, scroll down to the bottom, and you can see there's a little box there. You fill in your email address and click subscribe. And then every morning that Jiggers' Place is going to be happening, you'll get an email that has the cocktail recipe in it, and we can enjoy that together. So once again, and then next week on Monday at 10 a.m., Pacific time is my show, Trust and Estates Weekly. Tuesday at 10 a.m. Pacific time is my show, Business Lessons from the Military. And then, of course, a week from today, we'll be back for the next edition of People Making Money. So I thank you very much for joining me today. Wish you a wonderful rest of the day, and signing off as I always do.